So when people think about inflation, they often just focus on the expense side of things. But the great thing about multifamily is that it also impacts your rental growth as well. Because when the cost of goods increase, so do rents, right? So the cost of rents then increase as well. So the idea in theory is hopefully that the rental increases outweigh the increase in expenses, which historically has always been the case.
Hello, everyone, and welcome to the podcast. Today, Nathan Loy and I will speak to you about how to get inflation to work for you. So for many people, inflation is like a four-letter word. They're concerned about it. They just see prices escalating and they have money in their savings account and they don't know what to do aside for just holding on to cash. Well, here is an important question for all of you. Did you know that keeping money in your savings account is basically like throwing money away? Now, that's a difficult concept for many of you to grasp because you've got money in your savings account. How can it be like throwing it away? Well, that's the consequence of inflation, right? So even with a high savings rates like they are today, like maybe at 3-4%, these rates are still higher than inflation. So you're still losing money putting your money into a savings account. So Nathan and I today are going to discuss with you ways that you can get inflation to work for you. Well, welcome, Nathan. What do you have to add to this topic?
Yeah, absolutely, Robbie. Pleasure, as always, to be on. Really, I kind of want to start off the conversation with the idea that saving for or towards retirement really is kind of the slowest strategy to build wealth. And when people talk about investments and investing, they think they kind of start off at this baseline, call it 0%. But what they kind of really have to figure out is that inflation really is the baseline that you're trying to beat, right? The money that's in your savings account, that's really what you're competing against when you're investing. It's not necessarily 0%. It's whatever the inflation is at that current time, because that's how much your money is degrading every day.
Yeah. And that's a great point. So, look at what you're getting in your savings account and compare it to the inflation rate, which, Nathan, we just looked up today. What is it today?
3.2%. It's up. I think in June it was 3%, so it's slightly ticked up, which is why there's a consensus that rates are probably going to rise at least one more time in the future. And the theory behind that is the Fed will raise rates to really kind of stop or at least quell demand by making the cost of debt or the cost of borrowing more expensive.
Right. So, and that's really what the Fed is trying to do with raising rates, right? They're trying to combat one of the tools they have to combat inflation. And what you can do, a great way to look this up is go to the Fred economic data, the St. Louis Fed site. Just do a Google search of the St. Louis Fed. We all use this in the multifamily syndication business, and a lot of professionals use this account for up-to-date data. And you can look up what the federal funds effective rate is, what inflation is, and all the data that you need. And you can get graphs of this stuff. And what you can see is the inflation rate peaked, was back in May. Actually, yeah, I'm looking at the graph right now. Back in May, it peaked at like around May of last year, in fact. So am I looking at this correct? Sorry, give me one quick second. Okay. So inflation, no, it was like July of last year, 2022. So we're recording this currently in August of 23. It peaked at 9% and it's slowly coming down. It's coming down. So we're in much better shape than we were back then, but inflation still plays a role because prior to this, it was really hovering around, 1, not even 2% for many, many years. So the question we have, Nathan, is people have money in their savings accounts. They know inflation's a factor. What should they do to help use inflation to their advantage?
Yeah. First off, I in any sort of investment or anything I do in life, I like to understand the origin of what it is. So one of the things I like to fully understand is what is inflation, and ultimately it goes back to that supply and demand imbalance, right? When it comes to the cost of goods. So typically inflation is the cost of goods rising over a period of time, and that typically happens due to some sort of imbalance between either the supply of those goods or the demand of those goods. And it's almost one of those natural laws of nature where inflation is always going to be there. Cost of goods are always going to rise. It's just a matter of how fast they're rising, right? I'm sure if you talk to some of the grandparents today, they were talking about when Coke used to cost, 5 cents, 10 cents for a bottle. And I'd love to go back those days. That's really not how general economy works, right? The cost of Coke or any, food or gas of oil over time is always going to rise. So that's kind of the baseline for inflation. And what we're seeing, now is that inflation really kind of, came about what happened during COVID with the supply chain disruptions, the labor shortages, and kind of the excess money that you had from those stimulus checks. So that's kind of why we're seeing the inflation that was, I wouldn't say out of control, but abnormal from what we saw in different periods of history, right? And so as inflation got out of control, what the Fed was doing was they're raising interest rates, and why, some people kind of, got really upset that, debt was costing more expensive and then interest rates were through the roof. What they're really trying to do is try to combat inflation, get inflation back under control. Again, trying to control that supply and demand balance, because ultimately that's kind of the one tool that the Fed has, is try to control the demand side of that equation. They don't have as much power to control the supply shortages or the labor shortages. So what they do is they raise rates to really kind of control that demand. So what do you do then, right? You have, inflation that was, 8-9%. Now it's down to the 3 to 4% range, but that's still, you're losing money at, 3 to 4% day in and day out. What do you
Nathan,
do?
let me ask you this. This is just a fun question. What was milk? What was a carton of milk when you were in school? How much did it cost?
That's a good question. I grew up overseas, so I can't speak to what it
Okay.
was over in the States, but I remember it being a euro or like a dollar, $2 back in the day.
Oh, that's expensive. Okay, see, that means you're young. For me, a carton of milk was 5 cents. I still remember this.
No way.
Yeah, I bought a milk ticket in elementary school, and it was 5 cents. And lunch was 25 cents or 35 cents. 35 cents for lunch, 5 cents for milk.
Oh my goodness.
So prices have changed significantly, obviously, over time. I gauge inflation based on how much I'm paying for my kids' meals, because I remember how much I paid, and I'm like, man, times have changed. But it happens. It should happen, right? There's a baseline level of inflation, as you mentioned. But when it runs away from you, that's the problem. And just as you mentioned, people are like, "Oh, this sucks. The rates are so high. I can't get a new mortgage. I can't buy new properties because rates are so high." But actually, I'm very happy that this happened. I'm extremely happy, and you should be too, as a listener, because if this what did not happen, if rates did not increase like this, inflation would get out of control. And it reminds me of a story of a friend who lived in Zimbabwe, and this exactly happened there. And they have the currency is the Zims, I believe. So he went to the store and bought a loaf of bread, which was something like 400,000 Zims, for a loaf of bread. And the next day he went to buy something else, and he saw the bread price went up by like 50%, 600,000. He was like, how did it increase so much? And the guy was like, well, that's the price now. And the next day it went up even 50% more than that. And it got to the point where that money was literally not worth the paper it was printed on. It was literally trash. So that is a situation where inflation just runs away from you. And that's happened in many various countries. Luckily, being in the US, as we are, our money is quite stable compared to the rest of the world. In fact, a lot of the world uses the US currency, as many of you know, as their actual currency, or it's based off the US dollar. So we're lucky that it's not like that, but we definitely needed those rates to increase. And also in our business, I liked seeing those rates increase, because you were underwriting these deals, Nathan. I mean, the prices were insanely high prior to this rate increase, right? Like, what did you see? What kind of pricing did you see? Or maybe you could talk about how when we would put offers on deals, and we would try to, go to the best and final, and then best and final, how that process worked with the rates or with inflation. Talk about that.
Yeah. So, I mean, a year or two ago, debt was super cheap. So the best way to kind of talk about pricing is in its relationship to debt and where interest rates were. You could get, cheap debt for 3-4%. Granted, it was variable rate debt, so it's a little bit of a different story. But when you have cap rates that are at that 3 to 4% range, it makes sense, with debt being that cheap, that you can pay those prices. But again, that was floating rate debt, where once those same rates rise to 6, 7, 8%, you're in that negative leverage environment where the yields just aren't there, right? So what we saw was deals were trading in the high 3, low 4% cap rates, meaning that prices were, a lot higher than they have been historically, but they made sense for the current debt environment. But once that, debt environment shifted, and now with the Fed raising rates to make debt more expensive, and consequently the interest rates rose, that same pricing didn't make sense anymore, because now your debt's costing, high 4%, low 5%. The deals that were in that 3 to 4% cap rate they don't make sense. You're spending over a year worth of, quote unquote catch up to pay the same equivalent that you're paying out for your debt. So
yeah, and a lot of the lenders were actually loaning money at a very low interest rate, and they're also loaning at not only loan to value but loan to cost. which
Mhm.
means that loan to cost, meaning that you can finance some of your capital expenditures into debt. So like
Yep.
say for example you're renovating a 100 units and it's going to cost you $3 million. Well, the bank will lend 80% of that 3 million, and then you have to raise the rest from your investors. So it was the environment was such that money was so cheap to acquire, and inflation was I mean, I guess it didn't start running away at that point, but it was still rising. It was rising slowly at that point where I'm thinking of the time of the year, which was like, sort of like the post-COVID period. And the prices of properties were just insane. I mean, we'd go to best and final, best and final, and just constantly bid up, bid up, bid up. Sometimes like was 10 million below what
Mhm.
the final closing price was. And you mentioned cap rates at 3%. I mean, we were seeing even in some markets sub 3% cap rates, which was absolutely insane. So this
Yep.
correction happening was so important for everyone, investors, for us, for everyone, because we needed all that to calm down. I mean, we needed somebody to put the brakes on the market because it was getting out of control. And thankfully this happened, and now we're seeing prices come down considerably. I mean, we're seeing like 20% decrease in peak pricing right now.
Yep.
So the question now is, okay, inflation is happening. It's happening. It's not as bad as it was before. We're still in an environment which has higher inflation than we'd like. But what can we do now to use it to our advantage? So let's speak to that, Nathan.
Yeah. Right now, I'd really focus on cash flow. There's a saying that cash is king. Cash is only king if inflation never plays a role. But we know that inflation is there to stay, right? So cash in your savings account or even a retirement account really isn't as, quote unquote king or queen as it used to be. What's really kind of paramount now is cash flow, is the influx of new cash into kind of what you call your own ecosystem, your own kind of investment portfolio. When you have stationary cash that's being eaten away at by inflation, you really want to deploy that cash flow as frequently as often as possible at good returns at risk adjusted pricing too. That's the whole reason why people have really started to more heavily invest in kind of class A and class B assets, because they're less risky now than a class C asset is, right? For those of you who know those different asset classes, you'll know that the inflation doesn't affect all those asset classes equally, right? Someone who makes 30 to 40K, maybe even 50K, who's in quote unquote a C class apartment, that $50 rise in rent can really make a difference in their kind of bottom line than it would be someone who's making 70, 80K, who's more in kind of a class B or a class A type asset. So you've seen kind of a real focus on, even core plus deals now, where there isn't as much of a heavy value add lift, right? There's not as much renovations, and there's more kind of an upside in operations. But those are kind of less risky plays because you have newer vintage assets, you have a higher quality demographic, and though they might produce slightly lower returns than a typical value add deal, they're less risky, which is the perfect way to kind of combat inflation with a little bit of unknowns as to where interest rates are going to go, where inflation is going to go in the future. Those core plus assets really make a lot of sense right now.
Yeah, so I 100% would agree with you there. Investing in real estate is an excellent hedge against inflation, because as you can imagine, the cost of that particular asset is basically increasing as the inflammatory environment increases, and it's worth more over time versus your money is worth the same. So if you invest in real estate, you are protecting yourself. And investing in class A assets, as you mentioned, or core plus core assets, another way to state it, is a better bet, and it's more of a safe bet than investing in lower class assets. And I'll give you an example. We've got a good friend of ours invested in an asset that it was a class C asset, looked great on paper, looked like it was going to explode in terms of returns. But when this recession hit, everything just tanked because the tenants in that particular asset, that particular apartment complex, couldn't afford higher rents, and they potentially, or some of them, lost their jobs and they just left. And there's a high vacancy, a lot of turnover, a lot of non-paying tenants. It was a huge problem. So you can potentially make a lot of money in investing in Class C assets if you time it right. But that's the question. I was like, can you time it right? Versus a Class A asset, it's much more stable. So, Nathan, investing in real estate, investing in Class A assets, great way to hedge against inflation. What else?
Yeah. So when people think about inflation, they often just focus on the expense side of things. But the great thing about multifamily is that it also impacts your rental growth as well. because when the cost of goods increase, so do rents, right? So the cost of rents then increase as well. So the idea in theory is hopefully that the rental increases outweigh the increase in expenses, which historically has always been the case. So you may have a rise of expenses. Let's say it's at whatever inflation is right now, 3%. But if you have rental increases that are 4, 5, 6% on renewals and on new leases, your rental growth outweighs those increases in expenses, which again drives your valuation of that property. And what's really kind of cool is that during COVID, we saw a real kind of shift in what tenants were willing to pay for their residences, what kind of amenities they actually preferred. And so something that we saw recently is kind of a real big kind of uptick in smart homes and smart technology, where you're controlling the access to the home via your phone or the thermostat, because people were living at home during COVID, right? They had workable living space. So you saw a lot of outdoor fitness centers. You saw a lot more kind of communal working spaces. So there were these other income opportunities on these properties that didn't really exist before. So you can say inflation is a bad thing, but it actually presented an opportunity then to further that rental growth, especially on these kind of core plus type assets.
Yeah, yeah, and that's another great thing about multifamily is that the leases are a year, or at least probably on average a year, sometimes less, sometimes a little bit more, but every year they renew, and then you can increase rents to market. Versus, say, a retail property that has a 10-year lease, the lease is set for that period of time. With multifamily, you can constantly increase rents. You can raise prices. You can raise prices according to the market, so that you are making up for higher costs as well. The best part about it is if you were able to get a long-term fixed rate loan at the very low interest rates of like 2021, and you kept those properties, then you're getting those elevated rental rates, and then you're also maintaining that low debt. So that difference is massive, and you're able to capitalize on that.
Yeah, and that's a great thing too. Is you have cash flow throughout the hold period, and then through growing your NOI, through managing your expenses well and growing your rental income, you're actually growing the valuation of the property too. So for those investors who choose to take part in the upside, for us it'd be our Class B and reserve class, where not only do they get a preferred return, but you also get a 70-30 split of the equity or an 80-20 split. You actually have the consistent cash flow throughout the hold period, and you're growing the valuation on the back end. So you're actually, it's kind of like a win-win for if you're looking for appreciation and if you're looking for cash flow. It's great because you get cash flow throughout the investment period, but then you also get the upside when you go to sell the property or refinance the property too.
Absolutely. What other tips or techniques can you share with folks, Nathan, regarding inflation and ways to get around it?
Yeah. Right now, again, I would focus on fixed debt. I think that makes a lot of sense. There are some deals that could make sense with floating rate debt, but just given the fact that we know that the Fed's still trying to combat inflation, fixed debt really makes a lot of sense. To have stable debt, to not have to worry about your debt service, and have predictability. That's really kind of when things get a little bit hairy and a little bit risky, predictability is really kind of what you're looking for. You're looking for predictability on the rental side, on the expense side, and on the debt side. If you, as an operator or even as an investor, can control those three kind of facets of the deal, you'll be fine in any kind of environment, but especially one that is recession-like or one that has high inflation.
Absolutely. That's very key. It's the problem occurs when there's a flux, and you don't know what the future holds. But when you can underwrite something with fixed rate, even if the debt is at a higher interest rate, like we're seeing interest rates in the mid fives right now, maybe even close to 6%, which is fine, because if we're able to purchase a property at a debt of 6% and it's still to work and we're still to cash flow, that means that our value add strategy is absolutely working, and the cap rate is, at the time of sale, a disposition is going to be even higher than that interest rate. So even if the interest rate's high, don't let that deter you from looking at that as a potential investment, because it could cash flow enough so it makes up for it, and then you're probably buying it at a lower cost basis, right? And that's really what you're looking at now, is that you can get these incredible deals. In fact, what we're seeing coming across is amazing compared to what we saw just like, a year and a half ago. We're seeing price reductions of 20%. And Nathan, even today, we were talking about a particular deal that came across our table where there's a distressed seller and he was going to default on his loan, right? Can you tell us a little bit about that?
Yeah, I mean, you always want to have optionality when it comes to sell. You can really kind of, position your asset to really kind of time the market. The one thing that as you get towards that period of investment where it is kind of, thinking about, is it time to refinance? Is it time to sell? Is it time to hold? You really want to have optionality there too. So you're not really beholden on the debt market or a certain kind of buyer. So you can really kind of time it to what makes most sense for the health of that property. And so what you saw, a lot is these lenders who lent out, cheap debt at, high loan to values, high loan to cost. And so now you're seeing some properties that didn't perform as expected, but you still have the high debt service, especially with the variable rates that are happening right now. It makes it a tough situation for any operator then to be, kind of underwater and to try to claw yourself out of that situation, especially with the uncertainty where rates haven't stabilized yet. So yeah, we saw one property, and I'm sure there's more to come, where it was almost the lender's call to kind of say, hey, the property's not really performing, and we want to recoup the cost of our loan. And so now it's almost a forced sale situation. And in that type of situation, you don't have as much control over the purchase price, right? Typically, when you have optionality, you have a bidding war. You can really get the top dollar for your investment or for your property or for your asset. Now, if you're forced to sell, it's pretty much whoever's going to pay or whatever price you're going to pay for your asset, which is great optionality and opportunity for buyers, not so much on the seller side of things.
Yeah. I mean, that's where the seller defaults and they lose all the equity they put into the property, and the buyer can potentially get a great deal. But even this particular deal, it was not, we looked at it and we underwrote it, and we just decided, even though the purchase price was about 10 million, so maybe 20% less than peak, it still didn't make sense for us because there was so much vacancy on the property, so much deferred maintenance. It didn't fit our criteria. So we know we're going to get something that's going to fit our criteria moving forward, and more of these deals are going to come to fruition. But this particular one didn't make sense. But this is the first one that we've seen that came across where there was a distressed seller that was and the deal was being pushed by one of the brokers that we know.
Yep. And that's the thing. There's often, a heavy operational upside too, but that often means a lot of time and attention. Just like you were talking about, right? There's a reason that they weren't able to meet their debt service, right? Whether that be an occupancy issue, an issue with bad debt, so you're not collecting enough rental income. It could be a rise in insurance, a rise in taxes, right? There's a whole number of factors, but ultimately there's some sort of operational sort of lock and key that you need to figure out as to why that specific operator was not able to meet their debt service. Because typically, if you have, good operations and you're able to drive NOI, even if you're not in an ideal debt situation, you could have some sort of refinance because the value of your property is increased. But if you're sitting at, 30, 40% vacancy, it's just really tough to refi, and it's tough to sell.
Yes, absolutely. Well, there you have it, folks. We discussed ways that you could get inflation to work for you. Just to recap, real estate. This is a real estate podcast. We're always going to say real estate is the solution to every problem, right? But in all seriousness, real estate is a great hedge against inflation. We obviously like multifamily because for many reasons, but one of them is that you can raise rents. So as the market increases, we can raise rents according to the market, and we can keep ahead of inflation that way. And also looking at the rates, long-term fixed rate loans are very important. Make sure that whatever you're looking at has that in place, or at least a very tight rate cap, if nothing else, and a long-term rate cap at least 3 years. So if somebody's saying, hey, no, we're going to do variable rate, ask them if they have a rate cap in place and how many years it is. And then finally, be opportunistic. I mean, there are deals out there. There are deals coming as we speak right now in front of us. So you can potentially find something really good and something that people are going to overlook because they're scared to invest now. But if you're not scared to invest, you're willing to look beyond that and use logic and common sense and your underwriting skills and all that, and look for deals that make sense to you, then you can find some awesome opportunities. Anything else to add, Nathan?
Yeah, I mean, well said, Robbie. The only thing I'd add on top of that is kind of going back to what we initially spoke about, where people think about inflation and their kind of immediate reaction is fear, right? But fear comes from the unknown. If you're well educated, you know why inflation is happening, you know how to combat it. It makes a lot of sense to invest right now. One, you have the optionality of new deals, but the only kind of really downside on the inflation for at least the multifamily side of things are the expenses. But you have the upside of the rental growth. You have the upside of, potentially fixed rate debt that you could get, quote unquote, cheap debt. And you have the upside from appreciation from driving the NOI and the value of the property. So the kind of the pros of inflation really outweigh the cons if you're just well educated enough and you can choose the right investment. And that's safe for multifamily, it's safe for real estate across the board.
Wonderful. Well, I hope you got a lot out of this, and stay tuned for our next episode.
Awesome. Thanks, Robbie.
Thanks.